here. So we're going out. Pretty good rally to begin the second half of 2014. No down 17,000, but still a healthy gain, especially for the NASDAQ, up 1.16% on the close. Stay tuned. I'll be back this next hour as well as we get underway with the second hour of the closing bell with Kelly Evans and Company.
Welcome to the closing bell, everybody. I'm Kelly Evans. The Dow Jones Industrial Average and the S&P 500 today on the start of the month and the beginning of the second half of 2014 are closing in record territory. Here's a look, in fact, at how we're finishing up the day on Wall Street. Green arrows across the board, echoing what we saw, by the way, overseas first. Now, the Dow adding about 130 points. That's off the highs of the session, and considerably so. The NASDAQ, meanwhile, adding 50 points, having a strong day over 1%. The S&P up 13 to 1973. Let's talk about it with the panel today. Who better on a market day like this than our very own Bob Pisani, who's here. Welcome. Dani Hughes, founder and CEO of Divine Capital, is with us. Our Eunice Yoon in the house all the way from Beijing. Sharon Epperson joining us to talk markets. Fast money trader Brian Kelly is here. Welcome, everybody. There's a lot to discuss. Brian, are you surprised, though, that instead of getting closer to retaking the 17,000 mark, we gave up a little bit of ground there at the bell?
Yeah, no, I mean, we barely gave up anything. And the 17,000 mark for me as a trader really doesn't mean anything. What's most important is that over the last several days, we've seen some pretty good economic numbers globally. Europe PMIs, China PMI, ISM today, Chicago PMI yesterday. So all in all, we're seeing a global economy that appears to be improving, but importantly, not too fast, right? Because the big risk here is we get a big spike in interest rates and we choke off the recovery. We're a far way away from that, and that's what's important.
Yeah, Eunice, people forget sometimes, the trading day starts before 9:30 a.m. Eastern time, and a lot of it had to do with the data out of China. What is actually going on there?
Well, over there, it's definitely improving. We saw manufacturing data that came in for the PMI, and it looked a lot better than people had expected. And that really is setting the tone for the second half of the year. Everybody's saying, look at the new orders. They came in very strong. A lot of that is going to indicate that there could be a better recovery in the United States, and that's, of course, what everybody's hoping for.
When is the average Chinese investor going to believe that? Still, the Shanghai market down 3% on the year. It's been underperforming for years. When are we going to get those people
That's because Shanghai's more of a gambling den than it is a regular marketplace. So
Isn't that what this is, though? Isn't this a gambling den?
No, we're not supposed to talk about that.
That's what we've had. I guess we're not, but the truth is, I think a lot of this has to do with the central banks. That's really where we owe all of this credit.
Raise a silly and sort of elementary point that might be important here. I mean, there is a difference between investing in a stock, which is a stream of future cash flows, right, and doing things like betting with options, doing things like potentially even betting on commodities, right? I mean, like all of these, if you want to talk, because people will today, they're going to look at the headlines, they're going to look at Dow 17,000 and talk about whether it's a castle built on sand or air or whatever.
Yeah.
Is it or is it not?
Well, I think a lot of it has to do with the fact that a lot of retail investors aren't necessarily jumping into this market. They're looking at these new highs and they're saying, well, does it make sense for me to get in? And that's not necessarily a bad thing if they're sitting on cash for the right reasons, because they watched what happened in 2008. They want to make sure they have money saved for emergencies. They want to make sure they're paying off debts. If they're doing that and not tying up money in investments that they can't get out their money, then that's a good thing. If they're doing it and they're totally missing out on what could potentially continue to be a run-up, then that's a negative.
Have we lost that many people, though, since 2008? We keep talking about the investor on the sideline,
yeah.
and yet we knew that almost 50% of households were invested in stocks prior to that. Is it that far off now still?
Well, I think about 50% are probably still sitting in cash right now. I mean, but again, that's not necessarily a bad thing if they're doing the right things with that cash at the moment. I think the good thing that we're seeing, though, is that a lot of folks are saying, I do want to be in the market, but maybe in a different way. There's a new study that just came out from Fidelity showing that people, what they want right now, just as much as a 401k, they want their company to give them stock at a discount. They want to get in the company stock purchase plans. And so those are things that are now taking off and that employees are looking at as an alternative and in addition to what they're doing with their traditional savings.
I think that's great as long as it's not too much a part of everybody's investment. And
exactly.
You know that as well as everybody else. A lot of people made that mistake in the 1990s.
Right.
Let's hope we don't do it again.
You know, when your employer is also your biggest investment, you're probably putting all your eggs in one basket. What about the fact that, Brian Kelly, that when gauging what happens on the first day of the month, especially when it's the first day of the second half of the year, that this tells you something about positioning? Do you think that's the case here?
It can somewhat. I mean, if you see a big drop, you see some kind of window dressing, although I think that's a lot less than it used to be. I mean, the bottom line is we've got plenty of buyers here. The market's going to record highs. So whether people are on the sidelines or not, I think it's actually irrelevant. Ultimately, if they come in, great. The longer-term risk is that you have an aging U.S. Citizenship, and they will ultimately not invest like they did in the 90s. But for now, and I trade in the now, we're going higher.
Danny, I want to go back to something you raised too and point to James McIntosh had a nice short view in the FT the other day where he pointed out it's really unusual to see stocks rallying, bonds rallying, commodities rallying, basically all of these asset classes rallying at the same time and in unison. And doesn't that tend to happen, in fact, during periods right before there's a more troubling market development to come? Is it a sign perhaps of all of this intervention that we're seeing from global central banks?
Well, we see an actual war going on between the stock market and the bond market because they're both kind of predicting different outcomes, right? And, you know, of course, I'm rooting for the stock market. That's kind of where I've placed my bet. And a lot of other people have done the same, but there's a lot of worry. And I think that we see that in the bond markets and especially in the long-term yields, because you don't know, because the central bank has really controlled so much of this. That I think that's a big concern.
But do you think that the lower interest rate environment, now that people are really betting on it, that it's going to last for some time, that would embolden retail investors to come into the stock market more and more?
You would think, but it's emboldened corporations to borrow and buy back their stock. I mean, you see an awful lot of that, right? Because they can do that, and they see historically they're never going to get this chance again. So that's another risk.
The obvious point is we're all enthralled to zero interest rate policies. That's the end. Why is gold up 9%? Why are the bond market up? Why is the stock market up? Why are the commodity markets all up? We're all we're all into zero interest rate policies. I think, and the issue is in the second half of the year, can we see a gradually improving economy, and can we see interest rates go from, say, 2.5 right now to end the year at roughly 3.5? And can the stock market handle that? I think it can.
The thing that makes that difficult for people who are told to diversify is because of all of everything rising, as you're saying. That makes it difficult for investors to figure out, well, how am I going to diversify if everything's rising at the same time and the same catalyst is lifting all boats?
That's a good problem to have, though.
We've been waiting for the bond market to move down for a year and a half.
Until it stops.
A year and a half we've been waiting for. How long has it been?
A
year and a half.
But that's, I mean, that's exactly the point. Investors really shouldn't be waiting for the next shoe to drop or waiting for the back. They should be looking at the long term. Look, long term, this is what always happens. Yes, we see dips, but you know, if we had the kind of hindsight that Warren Buffett had and said in 2008, wow, this is a huge opportunity to gain value over the long run, I mean, we'd all be making those bets longer.
But you never hear Warren Buffett necessarily blaming the central banks for overly inflating asset prices. You know, I mean, obviously valuations will fluctuate, and he likes to go to work when perhaps because of intervention, there's been a crash. But I don't think he today, and he's been quite clear even when he talks about the market as being fairly valued, thinks that it's all just some kind of giant, you know, again, to your point, is this just some sort of false construct or not? I don't think he's the kind of guy who would come out right now and say,
and I don't think it is, Kelly. To your point, I absolutely don't think it's a false construct at all. I mean, companies are doing better. There's real wealth being made here. You know, this is not a Ponzi scheme. And when I said before that it is gambling, I mean, look at high-frequency trading. They're not investing in the stock market. You know, they're in and out. And that, to me, is gambling.
It's not a, it's one thing to say that it's not false what we're seeing moving up, but the Fed has definitely had an influence on the stock market. All the trading community believes this. When I ask the average trader, how much higher would we be or lower would we be in the stock market if the Fed had not intervened in the last 4 years? Average trader response I get that would be 2,000 points or more lower. That's a typical comment. And that may be right. That may not be a crazy comment. I put a lot of stock in store in just average investors calling up my 50
What do you think,
friends.
Brian Kelly?
Does
that sound about right?
Idea?
No, I mean, it's so hard to go back and prove that counterfactual. I mean, I would argue that we might even be higher if the Fed didn't come back. Maybe we would have flushed all the waste out of this system and we'd be able to rebuild
that's an interesting point.
Good foundation. You know, so I think that's very difficult to go back and try to say that's what's happening.
We got to leave it for some news, but Brian or Eunice, before we go, I just want to get from the two of you a quick thought. Brian, look, obviously we've got payrolls, we've got Yellen here in the U.S. that are going to be important to watch this week, but also out of China. I mean, what's the number one thing you think people have to be aware of in terms of catalysts to go one way or the other?
Well, people are watching to see whether or not the government's going to come in with more stimulus, because now now we've, a lot of people had actually hoped that the government was going to stick with reforms and not necessarily push in so much money. But now we're seeing more and more mini stimuluses, targeted stimulus, but at the same time, it looks like it could happen.